Welcome to our Taking Stock video for the week ending the 22nd of March 2024. I'm Kien Trinh, Head of Research at Stock Doctor, and today I'm joined by our Senior Equities Analyst, Jason Yin, to stream to your Think Share Market. Welcome, Jace. How are you today?
Very, very good, Ken. Trying to keep warm now that the cold weather's coming over.
It is certainly quite cold this week, isn't it? But before we get started, just a quick yet important reminder, the information we provide today is of a generic nature and therefore shouldn't be taken as personal advice. Remember, shares are volatile, so any past performance figures shouldn't be relied upon as a guide for future performance. Well, Jace, this week the topic of interest rates was back in the spotlight, and what was puzzling to me was the way the US and Australian markets rallied, even though the US Fed alluded to the fact that inflation was higher than they had forecast. Policymakers are signaling 325 basis point rate cuts for this year. Indeed, interest rate expectations are now higher than they were 3 months ago. And the chart on screen is a dot plot chart which shows the interest rate projections from the Federal Reserve Board meeting participants. Now, interest rates are forecast to only fall to 4.6% by the end of this year. And this suggests that the Fed is more inclined to keep interest rates higher for longer.
Yeah, it seems like a game of bingo with what's happening in the US Fed. Over in
Mm.
Australia, I mean, the RBA has kept the cash rate on hold at 4.35%, and the markets were pricing in a 25 basis point cut at its September meeting this year. But with the unemployment rate falling to 3.7% and stage three tax cuts flowing in the second half of this year, there's a risk that inflation and maybe interest rates might stay higher for a little bit longer.
Yeah, that risk is increasing as we speak, but higher rates, of course, will put pressure on shares because it not only reduces the present value of future cash flows, but also means debt costs will remain elevated. And this, of course, has led to the rising levels of insolvencies in the current market environment. About 967 companies entered administration in February, and that's 40% higher than a year ago. And the main drivers of this has been difficulties in companies generating their cash flows and also higher debt costs, as we mentioned, and of course, a lack of skilled workers leading to rising labor costs as well. And as a good segue from interest rate decisions by the RBA, the Bank of Japan, and also Federal Reserve this week, let's revisit our investment thesis on a borderline growth stock and also an income stock as well, Challenger Limited. Now, Challenger is an Australian annuity leader, and it was poised for a significant uptick in demand for annuity products in 2022. And for those new to Challenger, our investment thesis simplifies to this. Higher interest rates typically boost demand for annuities due to the improved yields these products offer.
Yeah, well said, Ken. And I think what's crucial here is that we've started seeing the benefits of increased annuity demand in the first half of FY24, which has been indicating an 18-month lag since the rate hiking cycle began. Therefore, even if rates do plateau around here, we expect the market for new annuity sales to remain strong for the next 6 months and even 12 months.
Yeah, adding to that, Jace, recent management actions indicate a promising earnings growth trajectory. In financial year 23, the company scaled back its dividend payout range to retain more capital for growth. But this has impacted its dividend. But looking at the forward gross dividend yield, it's still quite attractive at over 5%.
That's right. And the company's also launched growth and efficiency initiatives as well. And these include partnerships and technology upgrades. Impressively, though, based on the improved operating conditions of the first half of FY24, Challenger upgraded its FY24 earnings guidance. And this is reflected in the strong earnings revisions that you can see in Golden Rule 3.
Yes, those earnings revisions certainly look high, but forecasting annuity sales is certainly challenging due to numerous factors here. And these include future interest rate trends. You have the rollover rates of maturing annuity policies, also contributions from new platform and superannuation partnerships, and of course, the impact of Bank of Japan's recent policy shifts on Challenger's Japan distributor sales. Due to this, consensus have historically been quite conservative in their earnings estimates, and our analyst Ryan, he believes that there is potential for further upside surprises from here. The stock is currently trading at roughly a 10% discount to fair value, but make sure you review the active risk before making an investment. Now, moving across to another interest rate sensitive stock, and one we don't cover, is KMD Brands, which owns brands like Kathmandu, Rip Curl, and also Oboz. Jason, why does KMD continue to struggle more so than some of the other retailers?
Yeah, it's been an increasingly challenging situation for Kathmandu shareholders.
Mm.
The company's sales has been on a slow decline since FY19 when the company reached its sales peak. However, in the most recent reporting period, the first half 24, management noted that consumer sentiment remains really weak, and last winter has been one of the warmest on record in Australia, and this has significantly impacted sales given Kathmandu's reliance on its winter range. The company's sales were down 22% year on year, and we've also observed a decrease in earnings margins because management has increased the level of promotional activity just to move stock along.
Yeah, I've noticed, whenever I go to a Kathmandu store, there's always discounts going on,
Mm.
Jace, and analysts, consensus analysts, they continue to believe that the value is materially higher than where the share price is trading right now. Is this going to, lead to a recovery or perhaps a takeover story from here?
Yeah, look, it's a pretty interesting question. I mean, Kathmandu management have tried their best to sort of resurrect consumer sentiment and increase the loyalty in the brand, but it's been a pretty slow recovery. But if you look at some of the other segments, like you said before, Kien, Rip Curl, and also Obos, they've also seen large declines in terms of their sales as well. So it's been pretty difficult from an entire business perspective. And even if you were to look at operating cash flows, they are running into the negative territory. So a recovery is pretty difficult. From a valuation perspective, Ken, look, Kathmandu paid $350 million for Rip Curl in 2019, and that's what it's currently worth right now. So effectively, at its current price, you're buying Kathmandu and you're almost getting Rip Curl for free.
Wow, yeah, that sounds appealing, Jace. But Kathmandu, there's so much competition within the outdoor clothing space. They've lost market share to the North Face and also Macpac. And if you think about Macpac, that is a brand that's owned by one of our star stocks, Super Retail Group as well. And the business appears to be operating more efficiently with better product development here.
That's right, Ken.
Mm.
And turning our attention to the corporate calendar for the week ahead, there are no star stocks reporting the results. However, the end of March is generally a pretty busy period for REITs, which typically go ex-dividend. In terms of star income stocks, we have Arena REIT, Waypoint, and also Charter Hall Social Infrastructure.
Over the past week, we did initiate coverage on Breville Group as a borderline star growth stock. Now, I'm sure you are all familiar with the Breville brand, a large scale player within the home appliance market, which has a strong track record in delivering high rates of return on equity. Earnings growth has been driven by geographical expansion as well as through innovation, Jace.
That's right, Ken. Breville has consistently pushed out new products and has focused on maintaining its brand equity, which separates it from its competitors who have resulted to discounting their products in order to increase sales. However, if we look at the company's margins and high single-digit earnings growth, we have seen slight declines from its COVID peaks, and this is probably due to a moderation in sales.
Yeah, and compared to other retailers, Jace, in our opinion, though, Breville has a stronger grip on its current market share and also has a greater runway of earnings growth in the medium to long term due to the structural thematic of manual espresso machines gaining share in the lucrative coffee industry, which is also benefiting from the working from home shift as well.
That's right, Keen. I mean, the company has tried to expand its coffee range, which we estimate to be a substantial proportion of its sales. They recently purchased premium machines, Barazza, and also into other higher end Italian-made models as well. So that is setting them apart from a competition level. And they have been able to offer a range of machines starting from your lower end to your medium and potentially medium to higher end as well. And these are some of the innovations and some of the initiatives that management have pushed through to keep those high margins and high return on equity into the future periods. And one of the main reasons why we've placed Breville in the borderline star growth space.
Yeah, of course. And being in the retail sector, Jay, so, there are heightened risks around interest rates and also the fact that, can they maintain these high rates of return on equity, especially over the long term,
Mm.
when there's so much competition. But positively, I also noticed that the percentage shorted on the stock has fallen from a peak of around 8% in 2022 to only around 4% today. So we will continue to monitor this closely, though. For income stocks to be attractive, they need to pay a dividend yield well above the cash rate to compensate investors for the equity risk. There are currently many star stocks or many stocks paying an attractive dividend yield of 6% or higher. So how do investors know whether the dividend yield is sustainable, Jace?
Yeah, this is a question that we get quite often, Kian. First and foremost, you can find a list of sustainable income stocks by referring to our star income stocks. And remember, all these companies have been vetted by our analysts, and it is our belief that the forecast yield is sustainable and realistic. However, if you wish to assess a company yourself, here are a few things you should probably look at. Firstly, dividends are paid out in cash to shareholders, so it is important to assess a company's ability to generate that cash. So for industrials and resource companies, we tend to look at the trend in free cash flow, which is the cash flow from operations after capital expenditures. Ideally, you want to see free cash flow that is higher than dividend payments. In the example on screen, we take a look at BHP. Although the company's free cash flow is higher than the dividends, the trend in free cash flow is also declining, which is probably not the best sign for a sustainable dividend policy.
Yeah, and we also need to be careful here, though. Declining free cash flow may not necessarily mean that a dividend is at risk of a cut. A company could be making an abnormal investment in that year to generate stronger cash flows into the future, and they could subsidize the shortfall with the cash on the balance sheet. And this is where a qualitative assessment is important. Say, for instance, with Telstra, although free cash flow is currently lower than their DPS, it is due to significant capital expenditure this year. Notice that free cash flow is expected to recover in financial year 25.
And also, free cash flow may not be the most appropriate measure for sectors such as infrastructure, utilities, and also REITs, because these companies have a high capex profile, and that usually puts the free cash flow into negative territory. For companies that operate within these sectors, we suggest using operating cash flow, which is a more reliable measure because it represents cash from operations such as rental income for REITs, and this is often paid out in full.
Yeah, that makes sense. And let's not forget the financial sector, such as banks. Now, if you think about this sector, cash flow figures are not useful in assessing dividend sustainability because it could include cash from outside the business operations, such as customer deposits or loans. Hence, for financials, members should be looking at the trend in earnings per share and compare it to dividends per share. Also, check that the payout ratio is consistent with historical levels and not too elevated.
And another point to remember as well is that earnings for many companies are cyclical. And what this means is that dividends tend to be high during periods of abnormal profits, and they tend to dip during periods of earnings troughs. So to really understand the sustainability of the dividend, you need to look at the track record of earnings alongside the dividend payments and also dividend expectations into the future. And hopefully this would provide a more holistic approach on how defensive the business is.
Yeah, and this is where Stock Doctor really makes it easy for you to compare the historical dividends or free cash flow, just going back from year to year. As always, feel free to contact our analyst team if you need more details, or otherwise come along to our Lincoln Live webinar on Monday. That's all we have time for today, and thanks for your insights, Jason. Just wondering though, with the Easter holidays approaching, will you be dressing up as an Easter bunny for the kids?
Hopefully, I'll be dropping some nice Easter eggs around the yard next weekend, Kian.
Yeah, we just got to limit the amount of chocolate that the kids eat nowadays, so much
Sure
sugar.
do.
But also, just a reminder about our masterclass event in April. There are only limited tickets available, so make sure you reserve them as soon as possible. Also, as we mentioned, due to the Easter break, there will be no Taking Stock episode next week, but feel free to call us if you have any questions. In the meantime, take care and have a happy, healthy, and prosperous Easter ahead.